This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning, bright and early, 8 o'clock. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleague Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, the market is getting a bit sticky at these higher levels. So I guess a little bit of trepidation around 22,000. But let's see how the day goes. Long day ahead.
Well, long day ahead. Some nervousness in the broader markets. You have the expiry that plays out today as well. And there's a massive deal that's been announced overnight in the media space. So a lot to track.
A lot to track. And I think yesterday the market really took a dive, right? And a sharp sell-off, actually.
By the way, it's also 29th February today. So it's the first time in 4 years, right?
Oh.
Yeah.
It's not just any other day, guys. It doesn't come every year.
So what should we do on the 29th? That's the question.
Well, if you're born on that day, then you save 4 years. You're younger than you think.
All right. Well, we'll just quickly recap where we left off yesterday, as we always do, right? Yesterday was a sharp cut, and there's no two ways about it. The Nifty basically sold off about 250 points, and we left off at at the 20-day moving average. I mean, 21,951 is the close, as you can see on your screen. The closing yesterday was the 20 days 21,945. So exactly at the 20 days where we've left off, right? In one single full swoop, the markets kind of come down to that level. Overnight Qs have not been all that great as well. S&P is down a little bit. The Nasdaq is down about 0.5% or so. Just a few things on the global side. Fourth quarter GDP numbers were revised down, but the market actually fixated on that revision down, 3.2 compared to 3.3 earlier. This is the second estimate of the fourth quarter GDP numbers there. But the overall growth, some of the sort of internals were pretty solid, indicating that the economy is still doing just all right, actually better than all right. You had some Fed commentary, so there were two specific comments. Fed's William essentially voiced preference for at least 3 cuts this year. Markets actually around that, markets pricing around 2 or if not 3. And you had Collins, who essentially did not rule out a cut in May and wants a methodical easing later this year. I mean, a systematic kind of a easing for the rest of the year. The 10-year was down about 4 basis points. That was largely on the back of that GDP revision. So a little bit of cool-off, but around 4.3. Dollar index didn't go anywhere, around 104. Oil prices, again, did not go anywhere, about 83.5 or so. So except equities, actually, there wasn't very much by way of movement in some of these other areas. Tonight, we get important data. I mean, this is the Fed's preferred inflation gauge, which is the PCE number. Core PCE will be very much in focus. And because CPI has beat expectations, producer price index numbers have beat expectations, the expectation is that this is going to come in firmer as well. So tomorrow morning, maybe you're essentially going to look at slightly higher yields in the market kind of reacting to that. We'll see. It depends on the data. Now, the market here, right, it's kind of looked a little iffy, even if we've had basically dips which have been bought along the way. But the point is, at high levels, there has been selling pressure which has come in. And yesterday, we basically had the situation where, especially in the second half, the market fell off very sharply. So where do we kind of go from here? I think the first level is the 40-day exponential moving average. We closed at the 20-day moving average, simply put. And below that is the 40-day exponential moving average, which is 21,732. So yesterday as well, we put out the two support levels, 21,900, 21,700. Roughly speaking, the 20 and the 40. We are at the 20, and the next level perhaps is the 40-day exponential moving average, which is about 250 points away from where we left off, 200 points away from where we left off yesterday. A close below this perhaps opens up further sort of selling pressure and the possibility that this is perhaps a deeper kind of a fall. So far, in the month of January, for example, we had a few percentage points and then the market really moved back up, straight on. We've not had a proper, even a 5% kind of a fall. So the question is, could this be that one? And I think we'll only know once some of these levels go. Bank Nifty broke below key averages. For the last few days, it was looking like it was just wasting time, perhaps waiting for a cue from the larger index, which is the Nifty, to tell what to do. It's below both the 20 and the 40-day moving average as of the close yesterday. And the immediate target for the Nifty Bank is 44,911, which is the lower end of the daily Bollinger Band. I think that's the level to watch out for. The GIFT Nifty will come up on your screen. I would say that today is a do nothing kind of a day and wait and watch for some of these levels to come in. The market's been dithering at higher levels, and today we got to move on the opposite direction. You'd imagine that immediately the market gets bought in, and it's possible, but I think I would say give it a day, let the market tell you what it wants to do, whether it wants to once again defend this 20, 40-day exponential moving average, which has done in the past. Sonia.
Well, absolutely. There's definitely some caution in the system, right? And you can see it on the screen. I mean, the Nifty has been facing resistance at the 22,000 mark for a while now. In fact, if you just look at the chart of the Nifty, you'll realize that the last 3 times the Nifty has hit this 22,200 mark, it's pulled back from there. So definitely the market is facing a bit of resistance over there. Now, if you look at what's happening with the flows as well, 3 straight sessions, the FIs have been selling in the cash markets, and a total of 3,700 crores has been pulled out. So definitely there is some caution at higher levels even from the investor community. Now, the stock in focus, of course, today would be Reliance Industries and that mega merger that has been finally announced. This JV will create an $8.5 billion media Goliath, the Reliance Disney deal. Now, what this happens is consolidated market share will now be over 40%. So a near monopoly in this space is what we're looking at. Morgan Stanley put out a note where they said that Reliance is consolidating the Indian media industry and will leverage on its digital platform, improve returns as well as monetization. So that is one space that's going to be watched and discussed very closely today. But I also want to point out that it's prudent now to be a bit cautious in the broader markets because of what's happening. If you map the trajectory this month, the mid-cap index has now turned negative for the month, and the small-cap index is now down 5% from the peak that it saw last month. So in that context, some money is definitely being taken off the table. So the biggest takeaway for me from the last couple of days is that it's better to be a bit cautious now in the broader markets because things are getting a bit tricky over there.
I think that'll be prudent as well. Just some caution in the broader markets is warranted. But this series so far has gone to the bulls, though in fact the bears are making a bit of a comeback. On expiry day, who's going to conquer? That's going to be the big question because today things will get a little bit volatile. As Sonia said, there is some profit taking that's seen in the broader markets. Will we see a further correction? Will there be some more nervousness out there? It may not be such a bad thing as well because some of those weak hands, just buying anything and everything which was going up. So some kind of consolidation from the broader markets is warranted. The 20 DMA, both on the Nifty and the Nifty Bank, that's a crucial level. You don't want to get too much lower than those levels on the Nifty and the Nifty Bank. Let's first start off with the February series. It's been a good series, right? We've seen a good up move on the Nifty and the shorts have scrambled for cover. So even after the 250 pullback that we've seen, you're sitting on close to around 600-point gains for the series itself. At the start of the series, you'll be saying, we're net short. Well, it wasn't such a bad thing, and that's proved right. In yesterday's trade, on the options data, there was writing seen at the 22,200 call, the 22,100 call as well. Aggressive writing. The bears are saying, y'all have had a good series, but we want to protect our turf. We don't want the markets to go above this 22,250 to around 22,300 mark. Which brings us to the levels. Since there is the highest open interest at around 22,200, well, that's the resistance zone, right, in the near term. On the downside, support at these levels because the 50 and the 20 DMA come in at these levels. For the Nifty Bank, yesterday we ended a little bit lower than the 20 DMA. Now all eyes would be on the 100 DMA, which is a little lower from there, close to around 400 points away from current levels. 2 stocks I'm tracking. One is Shriram Finance. After the confusion the last few days, a little bit of nervousness out there. It's come into the Nifty, so some on the street had anticipated this, but in the last 2 days it got a little bit nervous, and normally we see that pre-play already taking place. But now the stock is fundamentally well placed, and the technical factor, which is inclusion into the Nifty, has also come in. So this could actually be the stock of the day because today's expiry and there were short positions that were rolled over for the next series. So Shriram Finance, that's the first stock. The next one that I'm looking at is macro tech developers. Intraday, very few stocks, only around 300 stocks ended in the green. And this one intraday saw a big recovery in trade. And in the last 1 month or so, the stock saw a 15% correction. It made a high in January 15th, the 52-week high, then it corrected close to around 15%. And from there, it's seeing some bit of buying. Also, the delivery data for the last couple of days is quite good. Even in the previous trading session, big delivery bar out there. The stock is looking up. So macro tech developers is another one that I'll keep on my radar for the next few sessions.
Well, absolutely. Shriram Finance, of course, 100%. I mean, yeah. I think that's a big one to watch out for today and beyond. Now, I just want to take 1 minute more and address something which is important. Now, this came yesterday, right? You essentially had this letter which AMFI, which is the mutual fund industry body, sent out to various mutual funds, and it got covered. But I think it's important to note that, this is AMFI's letter to mutual funds, But what AMFI is doing is essentially citing what SEBI has told them. This is the market regulator which is written to AMFI, and AMFI in turn communicating this stuff to mutual funds, right? And what are they saying? The title is what I think caught my eye. SEBI essentially told AMFI, and I quote, in the context of the froth building up in the small and the mid-cap segments of the market. I mean, that's how the letter starts. I mean, what the AMFI's put in the letter in terms of directions from SEBI, right? I would say it's a little unusual to see the sort of market regulator. We've not seen very often SEBI come in and sort of ring the alarm bells in such a forthright, straightforward kind of a manner by actually saying that, in the context of the froth building up in the small and the mid-cap part of the market. So this is, I think, in a way, and the letter was, of course, became public yesterday in the middle of the session, etc. I would say that yesterday's sharp fall that we saw perhaps had something to do with this particular letter as well. This is the regulator talking about froth building up in the mid-cap and small-cap market, not mutual funds, but the regulator. And I think I just want to emphasize that point. So just a few other things, what SEBI said, told AMFI. They said, ask mutual funds trustees to put in place sort of measures to protect the interests of all investors. Mutual funds should look into appropriate and proactive measures, including but not limited to moderating inflows, portfolio rebalancing, etc. They're basically saying that, look at measures including but not limiting to moderating inflows into mutual fund schemes. So we've seen various mutual funds. Kotak, for example, recently did that. I think they've put a sort of monthly cap in terms of what is allowed into some of these funds. Others have done it. Nippon, etc. The small cap fund did it earlier. It's pretty significant in that sense. And they're saying that steps are needed to ensure investors are protected from the first mover advantage of redeeming investors. Now, this is, of course, something which we need more clarity on. I spoke to a range of mutual fund CEOs and CIOs, and the feedback is that, there will be the need to put out more disclosures about what is the risk in the portfolio, what is the allocation to large and small cap, the segment of the market, etc., etc. There'll be a lot more disclosure from mutual fund side, which will be put out, which I think should be a good thing down the line. Sonia.
Okay, well, let's do one thing. Let's move on. We have plenty of opinion coming through for you this morning, so let's get cracking. Mahesh Nandurkar of Jefferies says that given the strong outperformance of India recently, expectations of a correction is building. He says analysis of market corrections over the last decade shows that 8 out of 9 corrections have been global and EM-led, and India's relative underperformance versus EMs during the fall has been 3 to 6 percentage points, followed by a sharp outperformance. He says rising domestic flows and a relatively light FPI positioning should act as a bigger cushion this time. Dips will likely get bought into, he adds.
Okay, some money market views here. Parul Mittal Sinha, Standard Chartered Bank, says that the USD INR has been range-bound this week with a broadly stable US dollar. She says the volatility in USD INR remains low as we continue to see inflows being absorbed by the local banks. She says inflows are likely to remain positive in the near term, with MSCI rebalancing on the horizon and positive trade deficit seasonality. She expects the dollar INR to trade in a range of between 82.88 to 83.05 in the coming week. Okay,
and on the bonds, Parul says the 10-year benchmark bond yield traded between 7.04 to 7.09% in the absence of any strong domestic or global cues. For the week ahead, she says the rates market is likely to take directions from global data releases, the SDL supplies and FPI inflows. She expects the 10-year benchmark bond yield to trade in a range of 7 to 7.1% in the near term.
All right, we have got a lot of stock-specific action to track for you. Get at that in just a bit in our special Top 10 segment. For the time being, we'll run you through the list. Reliance, TV18 Broadcast, Network 18 Media, PB Fintech, Shriram Finance, all of them will be reacting to news flow. Positive news flow, NTPC, Punjab and Sindh Bank, and Venus Pipes. On the flip side, you have UPL and KSP that will be reacting to negative news flow.